Hello traders, and welcome to another educational video titled The Bearish Engulfing Pattern. Let's go through the specs for this popular reversal pattern. The pattern is identified at the top area of an uptrend, and it consists of a small white body followed by a long black body. The small body is contained within the body of the second candlestick, is contained within the body of the long black candlestick. Now, ideally the white body is small and the shadows are irrelevant, meaning that it doesn't really matter whether the shadows extend above and below the long black body. But personally, I feel more confident when both the shadows and the white body is contained within the long black body. Good. And when we identify this bearish engulfing pattern at the top of a rally, then of course it has bearish implications. But as I always say, it's better to wait for a price confirmation, meaning waiting for a price to fall below the low price of the pattern. Let me show you a couple of scenarios here so we can truly understand, comprehend the specs of this reversal pattern. In the first case, the white candlestick doesn't have a small white body. It rather has a long white body, and also it extends above the black body. So the first scenario is not valid, and as such is not correct. Now, the second scenario, it's a valid scenario since the white candlestick has a small white body, and the small white body is contained within the body of the second long black candlestick. Now, the shadows, even though they do extend above and beyond the long black body, it doesn't really violate any specifications. So the second scenario is also valid. But I feel more confident, as I said, when both the body, the small white body, and the shadows are also contained within the long black body. So the third scenario is also valid. Good. Let's take a look at our first strategy. But before we do that, of course, remember to subscribe below, like and comment. Now, let's identify the bearish engulfing pattern on a real chart. And here we are at the top of the rally. A small white body is contained within the long black body. And of course, it has bearish implications. And as we witness on our price chart, the rest is history. The market collapsed. Let's take a look at our first strategy, a beautiful uptrend. And here we can draw an uptrend channel, meaning two parallel lines containing the high prices, touching the high prices, and the lower line of the channel touching the low prices. Good. Now, at the top of the rally, at the top of the uptrend, near the top area, we can identify a bearish engulfing pattern consisting of a small white body contained within the following long black body. Note that the long black body closes below the uptrend channel, alerting for the weakness of the bulls to maintain the uptrend. And also, we can wait for a price confirmation, meaning prices falling below the reversal pattern, below the low price of the pattern before we enter the market with a sell order. And as always, we are going to place a protective stop loss right above the high price of the pattern. And you can alter, modify, use different percentages, but in this case I use the 200% level to close part of our trade, and then we close another part of our trade at the 300% level, and then we close another part at the 400% level. Anytime we identify any reversal pattern in the opposite direction, it's a good excuse to close the remaining of our position. Good. Let's go on and take a look at another strategy. In this case, once again, we identify the bearish engulfing pattern at the top of the uptrend. We sell below the low price, and we place a protective stop loss right above. Now, the take profit strategy uses the Fibonacci extensions 161.8% to close part of our trade. Then we close another part of our trade at the 261.8%, and then we close the remaining at the 423.6%. anytime we identify any reversal pattern in the opposite direction, it's a good excuse to close the remaining of our trade. Good. One more strategy. Now we combine the candlestick reversal pattern, the bearish engulfing pattern, with oscillators. In this case, we're going to use our favorite oscillator, and we would like to see this oscillator to be overbought before we enter the market. So at the top of the rally, the bearish engulfing pattern, and the oscillator is being overbought. It's at an extreme area of the oscillator, and it's another excuse combined with the presence of the bearish engulfing pattern at the top of the rally to enter the market. Now we place a sell order right below the low price of the pattern, and we place a protective stop loss right above the high price of the pattern. Now we can use the 161.8 Fibonacci extension to book some of our profits by closing part of the trade, and then another part at 261.8%, and of course another part at 423.6%. We close the remaining of our trade anytime we identify a reversal in the opposite direction, and this is the case here with the morning star at the end of this downtrend. Good. So in this scenario, in this strategy, we combine the candlesticks, the oscillator, and the reversal pattern, if you wish, to exit the remaining of our position. Good. One more strategy, the Bollinger Bands. Using the bearish engulfing pattern, we identify the bearish engulfing pattern at the upper Bollinger Band, and after we do that, we enter with a sell order right below, and we place a protective stop loss right above the pattern, and of course we can close part of the trade at the 200% level, and then let it run until it hits the lower band, or if we identify a reversal pattern in the opposite direction. And this is the case with the hammer at the end of this decline. Good. I hope you enjoyed it, and don't forget to subscribe below, like and comment. See you again with another educational video.